Hey, what's up guys, John here. America's credit rating was just downgraded.
Credit rating agency Fitch has now downgraded the U.S. government's credit rating.
The U.S. government has its own credit rating, and now for the first time since 2011, that rating has been downgraded.
Foreign home buyers are pulling out of the U.S. housing market.
Foreign buyers of U.S. real estate are pulling back as well, and it's not just high mortgage rates, but high home prices, low supply of homes for sale, and a strong dollar.
Home lending restrictions are getting greatly contracted, and we're seeing massive corporate layoffs nationwide as they cut costs at a dramatic level not seen since the great financial crisis. We're starting to witness something huge unfold in the U.S. economy. And if you intend to invest in distressed real estate, you have a game plan to get wealthy, to get rich, when the market crashes, pay very close attention to what's going on here so that you can fit this into your plan to be sure that you'll be able to get access to capital, you'll be able to get access to money and do what you want to do. Because if you don't, you ignore this and you just go on with your life ignoring the reality, it just won't happen, I promise you. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's really going on in the U.S. economy. And if you want to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, charge-offs, medical bills, collections, foreclosures, bankruptcies, if you have any issue on your credit report that's holding you back from getting access to money, get a hold of us at GreatCreditFast.com. Click the link below this video to schedule a free strategy session. Take a look at this. CVS laying off 5,000 workers. Salesforce cutting more jobs following a 10% reduction. Layoffs.com, right? Or layoffs.fyi. In 2023, 228,000 jobs already lost, right? In 2022, it was 164,744 jobs, right? So at this current velocity, what we are likely going to see is another interest rate hike from Jerome Powell, which is only going to fuel more and more layoffs. We're probably going to see this number get closer to 400 to 450,000 layoffs by the end of the year. That is a massive, massive number. I mean, it's basically a 3x compared to last year. And as that's happening, this great resignation situation that everyone in America has heard about, you might have even been involved in it. A lot of people are looking for more money. They were recruiting, being recruited from other jobs. They were looking to just switch. They were looking to be able to offset this inflationary environment with a new job or a new opportunity. And so now that's all fading away. Employers are looking to reduce their overall costs. And so what does this mean? A lot of people have debt. They have auto loans, credit cards. They have other expenses, home loans, based on that former high income. And now that high income is getting slowly dwindled, but property taxes, insurance, utilities, the cost of living, cost of food, everything else is going up. And banks see that. They see that writing on the wall. And they are partnering up with the government to issue these new regulations that are going to just be a complete game changer. So here's how this is all going to break down. So America's credit rating just got downgraded, right? Foreign buyers bailing on the U.S. housing market. Here's why. Mortgage demand from home buyers drops third straight week. Here's what's going on. Politico. Banks warn on lending pullback, right? So U.S. banks expect tighter loan standards across the board in the second half of the year amid uncertain economic outlook, the Fed said Monday in its quarterly survey, right? So here's how this plays out. Banks will no longer be able to act as their own risk manager. Think about that. They're no longer able to act as their own risk manager. They implemented FedNow a couple weeks ago. Now, boom, they can't act as their own risk manager. Under the new rules, banks with $100 billion or more in assets won't be able to use their own models to determine risk they've undertaken on loans and other activities. Their risk level assessments have been the basis for informing how much capital they need to hold on top of baseline requirements. You might say, well, okay, well, what does that mean? How does that impact me? Here's how it will impact you. This is the average consumer, right? Some officials who voted against new regulations with the FDIC and Fed cited concerns that it could significantly constrain banks' ability to lend to businesses and individuals. Some also expressed concerns that banks would pass on their higher capital costs to consumers in the form of higher fees to maintain their profit levels. The increased capital requirements could lead to an increase in interest rates for low and moderate income and other historically underserved borrowers who cannot always afford 20% down. 20% down. Think about it. You know, nowadays $500,000 for a house is almost kind of expected. So, I mean, how many people have $100,000 just kind of sitting around where they can just say, yeah, I'm going to put $100,000 down, plus I have capital, in the bank, because banks are going to want to see that you have reserves. How many people are sitting on that kind of money? Not that many, right? Well, that's what's going to start to become the norm. making it much harder for families to achieve home ownership. FDIC Board Jonathan McKern said on Thursday at the agency's board meeting, said those who rely on these products and services will bear the cost of capital increases. Fed Governor Michelle Bowman, who voted against the new rules, said on Thursday, for example, when a local government issues municipal bonds to finance local infrastructure, they may need that financing. It's more expensive or in some cases unavailable. Manufacturers may find it harder to get loans to invest in equipment and facilities, she added. I mean, this is crazy. New bank, financial institutions like venture capital and private equity firms will likely fill the void for any lending that traditional banks will have to cut back on. I mean, just painting the perfect picture for private equity and these large institutions to go out there and just start swallowing up these properties, swallowing up these houses, these businesses, being the only game in town, right? This is what's going on here. A lot of people are ignoring it. This is the real fact. I mean, look at what's going on here. We have $1.1 trillion, $1.1 trillion in outstanding credit card debt, right? In 2008, great financial crisis was $1 trillion and $28 billion. But the big difference is now the average credit card interest rate, 22.39%. The average credit card interest rate in November 2008, 12%. So basically double. The interest rates have doubled on credit cards since then. And for context, if you're looking at 12% on a $10,000 loan, it's costing $1,835 over 2 years and 10 months, right? At 22%, it's like 22 and change, almost 23% interest rate. You go from paying that off in 2 years and 10 months to now paying it off in 3 years and 5 months, paying now $4,293 in interest compared to $1,835 in interest. Consumers are in really, really big trouble, and banks know it. And they put this article out 40 minutes ago, talking about bank lending standards as demand wanes. And so what they said is for credit card loans, banks reported tightening the extent to which they granted loans to some customers who do not meet credit scoring requirements. They also reported increasing the minimum required credit scores and decreasing credit limits. I've been talking about this in this channel, warning that this is what's going to be coming. Banks are expected to further tighten standards on all loan categories in the second half as lenders pull back. As Kiplinger previously reported, the ongoing turmoil in the banking system due to bank closures is raising concerns that lending standards may tighten even further, especially in light of the Fed's interest rate hike to a target range of 5.25% to 5.5%, the highest in 22 years. At a July 26 news conference, Fed Jerome Powell said he expected the loan survey to be consistent with what you would expect. You got lending conditions tight and getting a little tighter. You got weak demand, and it gives a picture of a pretty tight credit conditions in this economy. I mean, this is what's happening. And banks, businesses, everyone knows what's going to be happening next. It's going to be this. AI, artificial intelligence, wages are going to start to soften more and more and more and more. No doubt about it. This is what businesses are going to start implementing. This is what, this is what's going to be happening. They're saying that 85 million jobs will be gone by 2025, right? So how are people going to be able to afford? How are people going to be able to afford their, credit card debt, their auto loans, their mortgages, all of these different things as interest rates rise and credit tightens up, right? And then wages are softening. It's going to be, I'm telling you, the greatest opportunity, the greatest wealth transfer of all time for people that are smart and prepared, and they can actually digest this information, because sometimes it's kind of hard to look at this and be like, oh, this is actually reality, and just to ignore it, it's just easier. But if you look at facts and you're like, that is the fact, this is what's actually happening, and taking proactive steps, you're going to thank yourself in the future, looking back on the decisions you made today, realizing that that was a smart move. We're going to see, I believe, a lot of distressed real estate options. We're going to see a lot of even great opportunities for businesses. A lot of things are going to become available for pennies on the dollar. Because what do people do when they're in financial distress? They sell. And they sell because they have to sell. It's no longer based on price. It's based on motivation. They have to get rid of it. And that's what I think we're walking into. I think it's going to be the greatest wealth transfer of all time. If you want to fix your credit, you want to position yourself for this great wealth transfer. If you have a credit score below 750, we'd love to help you. Look at your credit report, tell you what we think we can do to help you and position you for this great wealth transfer. You can go to greatcreditfast.com, greatcreditfast.com. Go there, schedule a free strategy session, and we'll go over your credit report. We'll look at it. We'll tell you what we think the best plan of action would be for you. A lot of people are looking at their credit score like, hey, my score's not bad. It's a 680, it's a 690, it's a 700. If the average credit score is a 698 and they're tightening up lending standards for the average consumer, You don't want to be anywhere near the average consumer. You want to be at 750, 770, 800. That's where you want to be as a borrower. Because when you apply for credit lines, you're going to want to get approved. And you're not going to want to get approved for small little lines of $500 or $1,000. You're going to want $10, $20, $30,000 credit card limits. You're going to want to be able to go get this home, this investment property, to get a business loan. But you're going to need exceptional credit to be able to get that done. Because I'm telling you, this is all going to hit the fan. Like, we're going to start to see Jerome Powell hike interest rates and keep them higher for longer, and we're going to start seeing a lot more pain unfold in this economy. Drop your comments below. Let's have a conversation about this situation. This is pretty crazy, and yeah, I'll catch you guys in the next video.